Hey, everybody. Welcome to SumZero. Today we have Brian Finn from Findell Capital Management. We're going to be talking about Opportune Financial. This is an interesting situation. Brian's actually first posted about Opportune on SumZero about a year ago. The stock's up quite a bit since then. Brian's got some pretty strong opinions on kind of where the company's going and has sort of launched an activist campaign on the company. We're going to get into the weeds on kind of the sort of operational changes he's looking for today, let's dive right into it. Brian, you're the largest shareholder of the stock. I think when we chatted, you're roughly 10% or so of the company in terms of what Findell owns. You're obviously a long-term investor. Fundamentally driven. I think the company inside and out. The just quickly on the sort of stock dynamics. It's trading at $5.40 or so right now. Pretty wide trading 52-week range of 230 to 920 or so. It's $200 million market cap business with LTM revenues of around $760 million. You're obviously, you think there's a lot of upside even from current levels. So, why don't we just start with kind of how you first came across the name, just talk about the business itself, what they do, kind of their target customer, and just kind of broadly why you think the stock is compelling.
Sure. Let me just start out with a kind of a compliance disclaimer. So nothing we say here is meant to be a recommendation to buy or sell. This is not investment advice. We're here to just discuss our views of the opportunity at Opportune and our proxy battle with them. So I just want to get that out of the way first. David, good to be back with you. It's been about a year and change since we first discussed Opportune, and a lot's happened since then. But I think a lot more can still happen going forward here. But to just familiarize folks who are not familiar with the story, Opportune is a company that makes small unsecured loans to underbanked folks. So it's a consumer lending company. They've got this very interesting niche where they target largely sort of Hispanic folks who are hardworking immigrants who have jobs and are, call it, credit invisible. And this is obviously a growing demographic. And what's interesting about this niche is they tend to actually perform a lot better than other cohorts when it comes to paying folks back. They're just culturally adverse to carrying lots of debt. So Opportune's identified this great group that institutions have kind of ignored. That's a growing demographic. And Opportune's position within this group is pretty unique. So they've got the most data in the space. They've got a strong retail presence. So they are kind of where these folks are, as far as where they live. And they've got an incredibly strong brand. And as a result, they're able to get a lot of repeat customers and be the product of choice for these folks. So the way to think about it is if you're somebody who is, say, unable to get a credit card because you don't have any credit data on you, your choices are really to go to an Opportune or to go to a payday lender, which would cost you, hundreds of percent of interest. And Opportune's going to charge you somewhere in the low 30s to high 30% interest range. So in this sense, it's a wonderful business that serves a great purpose by giving these folks access to credit at a more reasonable rate and allowing them to kind of make the jump from being underbanked and not having a credit score to becoming part of the world of credit cards and more credit products.
And Brian, just for folks who are new to the stock, as far as their target audience goes, is it still mostly Hispanics?
That's where they kind of began the business. They have a lot of Spanish language material, and they're able to sort of meet these folks, in their native language and, in their communities. But obviously, it's expanded to other demographic groups beyond that. But that's really been their core focus. Part of the issue here that we'll talk about is they've deviated from that core focus, from that core demographic, to trying to kind of do a bunch of other things that really were not necessary to that core business. So just to kind of really frame things at a high level here, the way to think about this business is in terms of unit economics. And what this business should be doing is targeting a return on assets, pre-tax return on assets of roughly 10%. And the way you get there is you got to look at sort of 4 drivers, and that's total revenue yield, cost of funds, net charge-offs, and OPEX ratio. And the targets here should be high 30s on a revenue yield basis, so think like 38%. The cost of funds should be about 8%, and the net charge-off, which is people that are not paying you back, should be about 10%. And the OPEX ratio, which is the cost of running this business relative over your total loan portfolio, should be about 10%. So if you do the rough math here, 38 minus 8 minus 10 minus 10, you get to about 10% pre-tax ROA. Now, these are all very achievable numbers. In the past, they've run net charge-offs between 8 and 10%. The cost of funds today is about 8%. Where these guys can really improve and where we're pushing is on the total revenue yield and on the OPEX ratio. And the OPEX ratio is the most important part, and we'll talk about how that got screwed up. But if you look at Opportune today, they've got about a $3 billion loan book. So if they run this properly, this is a business that should throw off roughly $300 million in pre-tax earnings. And if you take the business today and fully dilute the share count, you got a market cap that's like 270 million or so. So that's the opportunity. That's the asymmetry here, that if properly run, this is a business that should be throwing off a ton of cash. And now they're not quite there today. So
and just set the like a little bit more on sort of the backdrop. You mentioned earlier that they're obviously not limited to the Spanish-speaking population, but I was actually checking in AlphaSense kind of expert network call transcript earlier, and there was a discussion with like the former founder actually, who this is pre Raul Vazquez, who mentioned that like there are roughly 20 to 30 million potential customers for them right now. They're like maybe 5% of that in terms of like their current customer base. So there's like enormous upside just in terms of growing, just growing the customer base itself. Would you say that's about accurate in terms of the growth runway for the business?
Yeah, obviously, I mean, from a demographic perspective, this couldn't be more perfectly situated. And one of the issues that this company had is they veered away from the amazing growth opportunity that was staring them in the face as far as pursuing these underbanked folks, largely of Hispanic descent. And they tried to basically become a fintech company and offer all these other products and appeal to other groups. And that's really what kind of threw these guys off course. So the reason why they're not generating this sort of ROA that I outlined is because of the CEO, Raul Vazquez, and the board, the legacy board members that oversaw him. And what happened?
Yeah, go ahead. You've said in your, I guess in our interactions that they've like Raul has torched you've made the claim that he's basically cost shareholders about $1 billion, over his tenure. So talk about like where that money went, how it was wasted, where you see these inefficiencies sprouting up. I guess in theory, like being a fintech and being a good lending business don't have to be mutually exclusive, but obviously it costs money to build new technology and stuff. So just if you can walk us through where you're seeing the waste, I think that'd be super helpful.
Yeah. I mean, I'll start at a high level. Opportune's OPEX ratio. So they're the best player in the space is this company called OMF, One Main Financial, and they've got an OPEX ratio of 7%. So that means for $100 million of loans outstanding, it takes about $7 million to run the business. Opportune's was in the high teens and the low 20s, and they ramped up the OPEX ratio to this very stupid level because they were trying to pursue all these other tangential create all these tangential products and pursue these other businesses. And we're trying to veer into fintech. And if you look at the background of the legacy board members and Raul's background, they're Silicon Valley people. They reimagined this very simple lending business as some sort of fintech empire. And that obviously blew up the cost structure. On top of that, they did a bunch of silly acquisitions, with the big one being buying Digit, which they did in, I think, 2021, or that time period. And they spent about $214 million on a digital bank and they bought it for like 12 times book value. It had about a $40 million revenue run rate at the time, and the revenue just over the next couple of quarters just collapsed. It was never making any money, and so they immediately wrote it down. So they did this big push to try to become something that they weren't, and we got involved because we saw the company blow up on their Q4 2022 earnings call, and we just started looking at their website, and there were 27 vice presidents listed on their website. And you start going through what these people do, and there were like 4 people who were the head of HR. You had 4 or 5 people that were in charge of credit. I mean, it was ridiculous. And so we just dug further, and we realized that these guys were running this business with about $200 to $300 million of incremental costs that just didn't need to be there. And so we started pushing the board and pushing the company to correct this and to refocus the business on their core lending business, which, again, if operated correctly, should do about a 10% pre-tax ROA, with very, very easy targets and targets that their competitors achieve and targets that they've achieved in the past. When we started pushing them on this, it was interesting. I mean, what they really cared about was not actually making the substantial changes that they needed to make, but kind of managing the PR of the whole thing. So when we pushed them on the VPs, they didn't go out and fire all these VPs. They basically scrubbed them from the website. And we saw this type of behavior, and it's been repeated really over the last 2 years. They've moved very incrementally and very slowly. So we pushed them to make some cost cuts, and they made a small cost cut. So it's been like pulling teeth to get these guys to do the obvious things that need to be done. And while we've been pushing them, the incredibly high OPEX ratio that they were running, ran into the fact that they were trying to cover up that OPEX ratio by growing the loan book aggressively. And that led to net charge-offs ballooning. And, with interest rates rising, their financing costs rose. So they had to do a series of dilutive raises to deal with the fact that they bloated the cost structure. If they had done all of these cost cuts that we asked for at the very beginning, they wouldn't have had to massively dilute shareholders here, which they've done over the last 2 years. Now, it's been a struggle, but we were able to last year push these guys. We were in a proxy fight with them last year, and we were able to get 2 people onto the board, a guy named Scott Parker and a guy named Rich Tambor. And these are guys who, Scott was the former CFO of OMF, again, the best competitor in the space, and Rich was the former chief risk officer. And they've been a part of the OMF turnaround, a decade prior. And these guys have really driven the company in the right direction now. And we can just see what happens when you have 2 people with actual lending experience on the board, pushing management here to do the right thing. And since then, the stock's really doubled. And, I think the story I'm going to tell today is a story of how the company is, things are going to get better from here. What we're pushing to do is to massively improve the governance here so that there's not a long-term risk to that improvement. And a lot of the changes that need to be coming here are not coming quickly enough. And this business, if operated correctly with the right set of governance in place and with the right people kind of overseeing it, could really drive a much different picture from an operating perspective than what we're currently seeing.
Yeah. So, I mean, I guess what is your current ask that you want to push for the CEO to be swapped out, or I guess like what specific operational changes are you pushing for today?
So going back to the 4 drivers of this business, it's the revenue, sort of your interest rate revenue yield, your cost of funds, your net charge-offs, and your OPEX ratio. The net charge-offs should start to just come down over time because they're not doing all the massive loan book growth that they did before. And that's, I think, having guys like Scott and Rich in there, making sure that the credit that they're doing is sound credit, will bring that rate down. Cost of funds is really a function of bringing down the overall leverage in the business. The two things that we've been pushing them on is revenue yield and the OPEX ratio. And the revenue yield, what they've done is they've shot themselves in the face by imposing an interest rate cap on the business, which might serve some virtue signaling purposes, but really prevents them from capturing a whole spectrum of customers here who are being denied credit because and having to go to much more expensive options because Opportune is capping their interest rate. So one of the things we're asking them to do is to remove their interest rate cap and to target, go into the high 30s for some of these folks who otherwise would have to end up, with a payday lender. So we think it's good for the business and it's good for their customers. And then, more importantly, we think that their OPEX ratio, which has come down because they're not doing all of the incredibly stupid things they were doing before, it needs to come down much further. It needs to go down to 10%. Now, our campaign here is really about this board. We're targeting the legacy board members here, and we're trying to improve the governance of this board. And there's a lot of things that we can say about the legacy board here. So to start, this is, as you mentioned, it's a $200 million market cap company, and they've got a 10-person board, and it's a staggered board. And there are really only 4 members here who are independent. They're the 2 that we brought on, and then there were 2 that were brought on by a search firm in early 24. And, that's great. I think out of those 4, 3 of those guys actually have lending experience. So, we're obviously happy to have those independent members on the board. The other 6, though, are all these legacy board members who've been there forever, who are essentially all, from what we can tell and believe, are friends of Raul's. And there's lots of things that are problematic about their existence on this board. And in many ways, their oversight is why we're in this position that we're in. And if you got rid of their majority control, the company, under the leadership of the 4 new board members, could be much more effectively managed and overseen and run. And the reason why we have issues with these legacy board members are, for starters, not a single one of them has a background in lending. Lending is obviously a very unique niche within the business world. It has different accounting metrics and valuation metrics. And that led to all sorts of issues with how this company reported. I mean, Opportune was using adjusted EBITDA as a performance metric, which is a ridiculous thing to use for a lending company. It might make sense in perhaps the tech world, which is where some of these folks have come from. And, by and large, if you look at the legacy board members, they're all either from nonprofit or they had middle management jobs in tech. The only one who really has an impressive resume is Neil Williams. And he's also problematic because Neil is friends with the CEO, Raul. Raul was effectively Neil's boss when Neil was the CFO of Intuit. Neil was a board member of Intuit. So now Neil's, he's the lead director of this board that Raul is the CEO of. And our experiences with Neil over the last 2 years, Neil has just done everything he possibly can to protect Raul. And, in addition to Neil having been the CFO of Intuit, you have other board members who actually worked at Intuit underneath Neil. So board member Jenny Lee she had some middle management position at Intuit. And as we kind of dug into some of these relationships, it's become clear, just how compromised it has made the board, not just in their oversight of Raul, but in how they've managed things like, for instance, the acquisition of Digit. So what was interesting about that acquisition is it looked like these guys did zero diligence because they bought a company that immediately failed and cost shareholders a lot of money and a lot of dilution. And why would they do something like that? Well, it turns out the founder of Digit a guy by the name of Ethan Block, had sold his prior company, had been part of a transaction with Intuit, which obviously was where Neil was CFO and where Ginny Lee worked and where Raul was a board member. So these guys had some sort of personal familiarity with Ethan, and it turned out he was also on Joanne Barefoot's podcast. So there's all sorts of conflicts of interest on this board. These board members, we weren't looking for an activist fight. We were looking to just try to reduce the board from 10 to 8, or to have some of these folks on the board who have lending experience actually be in positions of power, as committee chairs or as the lead director. And they refused both of those offers. So these guys, their only interest here is continuing to serve on this board and collect the paycheck. From our perspective, they've shown very little sense of fiduciary duty to shareholders. And I constantly compare it to our experiences. We're in another situation with another company that's also an activist situation. It's not something we've gone public on, but it's a situation where this other company, has done a lot of stupid things and, has had a CEO that's veered off in tangential directions. But this other company has a real board. It's not a staggered board. None of the board members are personally beholden to the CEO, and they take their fiduciary responsibilities very seriously. And it's literally, it's just night and day comparing that board to the Opportune board, which again is controlled by these legacy members. None of them are particularly, none of them are all qualified to be on this board. And their behavior with us has just been kind of amateurish. What they're in this proxy contest, what they're counting on is, and what they've continuously referred to in kind of why they're refusing to accept these obvious governance improvements, is they believe that the warrant holders, the folks that they did the dilutive financing with, Neuberger, Bergman, and Castlelake, are going to convert their warrants and vote with the legacy board holders, the legacy board members. And they're kind of telling us, wink, wink, we have these debt holders in our pocket, and they're gonna do something that they normally don't do because we gave them a good deal, and they want future good deals from us. And as a shareholder, obviously that's enraging to hear. And if you look at how shareholders have judged these guys in the past, I mean, this is the first real proxy contest that's going to go the distance, it looks like. And in the last 2 years, in 23, again, this is a staggered board. They had 2 board members run in 23. They ran unopposed, and they received, in one case, more withhold votes for Sandra Smith and confirmed votes. And for Joanne Barefoot, it was roughly even. So shareholders have already just expressed their displeasure. Last year, Ginny Lee would have decisively lost had we not come to a cooperation agreement with Opportune. So shareholders have spoken in the last 2 years. They'll speak again in short order. Since we began our entreaties to them, we've had countless folks who've worked at Opportune, countless shareholders reach out to us, all telling us that we're doing the right thing here and that this is a company that's been just completely mismanaged by Raul, who's been overseen by a group of handpicked friends, what we believe are handpicked friends, who have little understanding of the business and have let Raul sort of do whatever he wants. He's essentially acting like an imperial.
What does the comp package look like for Raul, as well as the board members that you think are the most compromised?
Raul's been paid, it's been a lot of stock, but, a fair amount of cash as well. And he's been paid millions of dollars. Like he was paid $5 million. I actually don't have that in front of me, but, he's been paid millions of dollars while he's sunk the company here. As far as who's most compromised, I mean, I don't know. It's just their interactions with us. Again, I have this compare and contrast to this other board. Either they are, just completely inexperienced and have no idea what it means to be a part of a board and to have a fiduciary responsibility to your shareholders, and aren't going to do the obvious governance changes, or they are truly just acting in a way that's just in complete violation of their fiduciary responsibilities. So I don't know if it's ignorance or or they're acting unethically. I'm not going to comment on either way, but the results speak for themselves. How this company's performed over the last 5 years, the turnaround that's occurred, and look, there's a turnaround that's happening here, and I don't want to take away from that. But it's been driven by our entreaties. It's been driven by the stuff that we've sort of brought to their attention, and the stuff that we've been pushing as far as the cost cut reductions and the business focus and bringing on people that actually have real lending experience, like Scott and like Rich.
Have Scott and Rich been culling some of the expenses related to whatever fintech product initiatives they've previously spent money on, or like where are you seeing their impact the most?
I mean, look, I have no idea what actually, I can't speak to what their individual contributions are, but they're real guys who understand the lending business. And, in our discussions with them, prior to them joining the board, it was very clear to them what needed to occur here as far as, getting rid of some of these tangential products and focusing on the base business and, improving the credit box to get the credit in shape. And likewise, those are all the things that we've seen happen subsequently. So we think that they're having a real effect here, and you can just see it obviously in the performance of the stock. So clearly, the better oversight you have here, the better Opportune will be positioned. And our goal in this proxy campaign is, we think if you really if you got rid of the legacy board control, so if they were no longer in the majority, and you had real oversight, we're not going to speak to, obviously Raul's track record speaks for itself, but this contest is really about having real oversight on management. And, what a true independent, competent board wants to do with management in the long run, is up to them. We're not commenting on that or going to have a strong position on that. The goal of this proxy contest is to force real oversight on this management, because there are very obvious things that this company can do in the near term to drive a much higher ROA, again, with the interest rate cap and with the OpEx reductions, and then bringing down some of their leverage. And this board has just shown itself to be completely incapable of providing any oversight, and they look just incredibly captive to Raul. It's really, I mean, the way to think about this is, it's not. I think ourselves and the folks we're opposing here, I think we all want to land the plane, if you will. But we've just had so much experience with these board members, with Neil, with Ginny, and with these other board members, to just know that they're not the right people to be in positions of power on this board, just from a pure competency perspective and from a lack of industry knowledge perspective, and we wouldn't feel comfortable being long-term holders of Opportune, which is what we've been, without having folks who actually have lending experience running the board. This is a lending company. They need guys like Scott and Rich and Carlos, who was the guy that was brought in independently, in positions of leadership, controlling this board, because there's a lot that can be done here. And we've just seen over the last year what was done, just having 2 people on the board, 2 out of 10, who actually have a modicum of lending experience, because this really is an incredible niche to be in. It should have incredibly high ROA. They're really in like the most perfect sweet spot from a lending perspective, but they've just gone off on all these crazy tangents and imagined this something
speaking
that really
to that, like assuming you win the proxy, you kind of get that majority control over the board. What's sort of a fair multiple that you would put on, what you project to be steady state earnings for the business? Like you mentioned, that you sort of expect on a $3 billion loan book that they should be doing roughly 300 million in earnings. Like what sort of multiple do you put on that? What kind of upside would you see if they were able to kind of right the ship?
Yeah, look, I think they're going to continue to report good results this year, again, because of the things we push them on. And the stock should work in the near term. just because the credit's turning and things are getting better operationally. But, in the long run or in the medium run, if we're able to get the right oversight here and drive these guys to a 10% ROA on a $3 billion loan book, that $300 million in pre-tax earnings should trade at least 5 times. So you're looking at a business that's worth $1.5 billion, and that's where it should have been today, and would have been today had these guys reacted more quickly to our entreaties 2 years ago. So the stock may rally into after earnings here. I mean, we have no idea what the earnings are, and we have no idea what the reaction will be, but shareholders here shouldn't be happy with an $8 or $9 stock if that's where it is in a couple of weeks. This should be a $30 stock. This should be way higher if it's properly managed and has proper board oversight. So that's what we're pushing for, and that's why we're excited about the opportunity here. There are comps that will trade for, I'm trying to think of OMF, trades for a multiple of book value. Opportune trades for a fraction of book value. So there's a way to get a multiple upside here if they can just start trading in line with some of their comps. But to get there, they got to start generating the sort of return metrics that those comps do, and they're very achievable metrics if you had somebody really driving the horse here. But the problem is you've got these board members that are just looking to kind of keep their jobs, and you've got a management team that's sort of flailing about, that just kind of reacts to. It's just been reacting to our pressure basically, and they've obviously made some improvements here. But the point is, there's a lot more that can be done here to drive just a much higher return.
Yeah, that makes sense. Are there any macro-related risks here that are worth noting? I mean, obviously it's a pretty idiosyncratic situation, but macro has been a pretty important driver of markets of late. So I'm just curious if you have any thoughts on that.
Well, yeah, of course. I think the macro situation has gotten a lot better. I think these guys are sensitive to obviously to inflation and to unemployment. But I think to see things get worse from here, I think you'd need to see unemployment get a lot worse. Obviously, we're still in a good position from an unemployment perspective. I think inflation, when they were in an environment with very high inflation, that obviously has a much bigger impact on these lower socioeconomic classes. But again, the macro environment could change, which is why it's so important to have responsible people overseeing the board and driving this management team, making the long-term decisions here. The macro environment's favorable for now, but that could obviously change. We think that they should be well positioned this year. But if the macro environment, if we end up with like much higher unemployment and we go through a big recession, that's obviously a different situation. And I think if you want to be a long-term holder of the stock, you want to own it with this sort of $30 price target, then you need to feel comfortable that you've got a real board here providing real oversight. And with these legacy board members still having majority control, and still basically just kind of rubber stamping whatever the CEO wants to do, you're not going to have that sense of security.
Is there what catalyst would potentially cause you to rethink your own thesis on this? Like what would maybe cause you to sell? I know you've got a $30 target price, which is a long way from where we are now. What would maybe cause you to throw in the towel and just say, hey, I've had enough of this, and kind of move on?
I mean, look, I think if we see, I wouldn't put anything past Raul if we see him do something crazy here, or we see him further empowered. Our thesis is on getting, more oversight and more control. Shareholders, taking this gem of a lending business and being able to drive it to where it should be operationally. And, you've got somebody who's just kind of consistently failed and has only stopped failing after responding to our entreaties and to having real people on the board, if that oversight goes away or is lessened, then history can repeat itself.
And are there any other competitors? I mean, you've mentioned OMF, but are they kind of the only other player in this space? I mean, they've got this niche that's quite unique, but I'm just curious if you see any entrants in the market or any risks just from a competitive standpoint.
You've got RM as well, as far as other public competitors, but really, and that's regional management. But really, one means sort of higher credit quality than Opportune, but it's a wonderful business. They've got this niche to themselves. Ultimately, they're trading for a fraction of book value, and this is real book value now. It's real tangible book value. So, as far as thinking about, I mean, could somebody buy them? Like, yeah, maybe a private equity firm could buy Opportune, but I think this could be run as a standalone business very, very profitably if you made some of these OpEx cuts and you got rid of the interest rate cap, which was just a self-imposed thing that they did, to try to look good. Again, something tied to Raul's ego. And on the OpEx, points, I mean, they might push back and say, oh, we've made a lot of cuts. Well, look, these guys were they had a $600 million operating expense when we started pushing them. And they've taken that down 200 million, and there's been no change to their business. So, the idea that they have any idea what the right OpEx ratio should be for this business, I think is disproven by the fact that it was taken down by 200 million and there wasn't any change to the business. And when we first started pushing them on it, they claimed that they were running, effectively a tight ship. So I don't think they have any idea what the right cost structure is. Their competitors are obviously, like OneMain's way lower at 7%. We think they can get to, at the very least, the low teens. They can get to 10%. And if you did that, you'd unlock a tremendous amount of value here. Those two things would really drive this company, and you can do it very quickly. These are loans that turn over every, they're like, the average duration is 18 months or 12 months or somewhere in that time frame. So this is not a hard business to turn around. This isn't like you're putting out 10 to 20 or 30 year loans. These are very short duration loans. So if you take out some of the OpEx, you get rid of some of the interest rate caps, so you can capture more of that higher 30s spectrum of the market, you can really drive returns here in the near term.
Do you know what percent of the OpEx is sort of like very discretionary marketing versus like actual headcount that you think is bloated?
Well, we know they basically, let me pull up the data here, but one of the first things that we pointed out in our letter was how their headcount had essentially doubled across the board from 2019 to 2023, while OMS had basically stayed the same. So, we're asking them to get back to a position that they were in, in 2017, 2018 from an OpEx per loan perspective, which is very doable. And they were able to mask some of this crazy OpEx by increasing the loan size and, doing many more loans. So we think an OpEx, they need to get back to where they were in 2016, 2017. What the percentage mix is, I don't have those numbers right in front of me, but they did blow out their headcount, from 2019 to 23 when we started agitating for them to start taking out their OpEx. Yeah, I've got the numbers here. I mean, their corporate overhead went from 583 in 2019 to like almost 1,000 in 2022. OMF,
yeah,
their overall employees went down during that time period.
Yeah.
So they exploded their cost structure basically with people, and everyone kind of works from home, and the color we've gotten from former employees is it's like this is a great place to go work for if you know if you're not interested in kind of getting driven hard and you know it's a very lackadaisical culture and everything else. So you know we think that there's a lot of OpEx that can be further taken out of this business if they really you know tried.
It sounds like they need a little bit of Musk energy in the corporate culture. Brian, I think that covers most of it. If there's anything else, is there any other aspect to your thesis that you wanna bring out before we close it?
If there's any questions that people have in the audience, I'm happy to engage anybody. You know, I think if hopefully, you know, yeah, I hope these guys have a great quarter. I hope the stock continues to work from here. But the reality is that we think it could work a lot better with the right board leadership. And you know, I think if you're going to be a long-term holder, you need to see this board have folks on it who have real you know lending experience.
And is there any sell side coverage on the name?
Yeah, you've got a handful of banks here.
What's the consensus from their standpoint?
I'll pull it up. I mean, I think people are starting to warm up to the idea that probably the best guy on the name is John Heck or Harold from B. Riley. Those are, I mean, John Heck is kind of probably the most famous sort of consumer lending analyst in the space, and Harold's good as well. But I think people are starting to warm up to the idea again because you know they are seeing the turn in credit, and they are seeing some of these cost improvements start to flow through.
A couple of questions here from folks listening.
Yeah, so I see the CFO one. I don't think he's been named. I mean, look, to be clear, yeah, him being the whatever they called him, like I think he was named director of finance. I don't think I think there's an interim CFO. Again, I think that was an amateurish move on the board's part. Yeah, he's been declared the principal of finance. I think you need to have a corporate officer who gets named that in order to be able to sign off on the books. I don't have any reason to think that there's any accounting issues here. You know, I think it's a clean book value. As far as why the CFO left, Jonathan, you know, I think it's because of health reasons, but I don't have more color on that. I don't think it has anything to do with the company, you know, about to have some real serious issue here. I do think the company is starting to turn. And I think, you know, the point of this campaign is to drive, you know, a much bigger sort of operational improvement and a governance improvement. And, you know, if we can do that, then we can feel pretty confident about becoming, you know, multi-year shareholders here.
Question on buybacks. Is that a possibility?
Well, I mean, that's another reason why we need to have responsible board members in place here is because they are going to start to generate a lot of cash. And you want that cash to be allocated, you know, efficiently and effectively. And Raul and Neil have shown that they're total failures at that. So you need to have responsible actors in positions of power driving the right capital allocation decisions. And yes, there could be a ton of buybacks here once they get the ROA to sort of the levels that we think they can get the ROA to.
Who's the auditor? Who audits the company? Do you know?
I can look it up.
Yeah, not a big deal if you don't have it at your fingertips. I think it's great. It's a super interesting situation. Highly asymmetrical. Question about Mr. Wilcox joining the board.
I have no idea. I mean, look, we're gonna have a proxy fight here. It looks like. I mean, we've given them 2 easy outs. They didn't take those easy outs. These legacy board members want to maintain their positions as heads of committees, and they want to keep their. This is a nice. They're all essentially retired. One's a former accountant. The other two kind of had middle management jobs in tech. One has a podcast. One has, then you have Neil, obviously. But this is, except for Neil, I think this is probably an important source of income for all these people. And they don't want to give up their seats. And so, even though we gave them the board 2 very easy outs here to reduce the board from 10 to 8, and to just have, the directors who have lending experience as in leadership roles, they didn't take that. And I saw the other question of, can shareholders sue Raul here for mismanagement? Obviously we think it's been incredibly mismanaged, but we do think that the company is on a better track here. But there's been unforced error after unforced error historically, and in order to drive this company in a better direction, Raul needs to be. He can't be an imperial CEO. He needs to have proper oversight, and we need to have lead directors who have lending experience who can really drive this business forward. The magnitude of the shareholder. I'm just seeing this next question. The magnitude of the shareholder destruction, is, I guess one could argue it deserves a lawsuit, but that's not what we're contemplating at the moment as activists here. We're just trying to see that this has a clean board, and that we can drive much further governance improvements and operational improvements, and Opportune can become the sort of company that it should be. Have I spoken to Raul? No, I've not spoken to Raul in a long time. Started interacting with him earlier in the process, but then it became kind of apparent that this was a guy that had a huge ego, and he wasn't going to listen to a hedge fund telling him what to do, and he built up this little empire, and he still thought it could work. And so we just started appealing to the board directly and pushing changes through the board. And again, these guys will do everything they can to push back and to not react, which is why we've had to continue to engage them publicly, as much as this is not something that our fund typically does, and not something that I've enjoyed doing. But there's just such a tremendous amount of upside here if you are able to get the right principles involved. Anyways, I'll leave it there, Divya.
I think we can close with that. This is a great summary. It's encouraging that despite all of the maybe misguided decisions on the part of the company, they've still got this sizable loan book. Thanks for taking the time, Brian, and thanks to AlphaSense for giving us access to some of the conference call and expert network data that we have. We're going to be sending folks a follow-up, and folks will be able to review both this call and also I think for those of you who are interested in accessing anything on AlphaSense as well, we'll be in touch about that as well. But Brian, thanks again. Super interesting situation. Love the sort of combination of it being like not covered by Wall Street and having this like hugely sort of asymmetric upside. It sounds like a 5 to 10x type of situation if it plays out kind of the way you're seeing it. But yeah, we'll certainly be tracking it and looking forward to having more of these conversations.
Okay, thank you, Divya.
Thanks, Brian.